Savings accounts and checking accounts are two core types of bank accounts. Knowing their key differences helps you manage your money better. The purpose of a savings account is to help you grow your money by earning interest. In contrast, a checking account is used for daily transactions like paying bills and making purchases. Understanding when and how to use each account can improve your financial health. A savings account is a deposit account designed to help you save money over time. It allows you to earn interest on your balance, which means your money can grow while it is safely kept in the bank. Savings accounts are ideal for storing funds that you do not need immediate access to, making them a great choice for building emergency funds or saving for future goals. Savings accounts offer several important features. First, they earn interest, which means your deposited money increases over time through compound interest. Second, these accounts have limited transactions each month, usually up to 6 withdrawals or transfers. This limitation encourages saving rather than constant spending. These key features make savings accounts useful for long-term financial goals. A checking account is a transactional account designed for frequent and everyday banking activities. It allows you to make unlimited deposits, withdrawals, and payments. Checking accounts are best suited for handling daily expenses such as paying bills, shopping, and withdrawing cash, giving you easy and instant access to your funds whenever you need them. Checking accounts provide unlimited transactions, meaning you can deposit, withdraw, and transfer as many times as you want without restrictions. However, checking accounts typically offer little to no interest because their main focus is accessibility and convenience for daily money management. They are ideal for keeping money that you use regularly. There are 4 major differences to consider. Savings accounts earn interest, helping your funds grow, while checking accounts offer little or no interest. Savings accounts limit the number of transactions you can make, whereas checking accounts allow unlimited transactions. Savings accounts are meant for long-term saving, while checking accounts are for everyday spending. Finally, checking accounts usually provide debit cards and checks for easy access, but savings accounts often do not. Savings accounts are best used for emergency funds, future goals, and money you do not need immediate access to. This makes them a good choice when you want your money to grow safely over time. Checking accounts should be used for daily expenses, bill payments, and any transactions requiring frequent access to your funds. Having both accounts allows you to manage your finances effectively. Both savings and checking accounts serve different but important roles in your financial strategy. Having a savings account helps you grow your money and plan for the future, while a checking account provides convenience for everyday spending. Using both types of accounts together helps balance saving goals with easy access to your money when you need it.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.